You're listening to the Retire Coast podcast, where money, business, and lifestyle come together. Join us each week as we explore smarter financial planning, starting and growing businesses, and building the life you want at every stage, from millennials and Gen X to today's retirees.
We're going to talk today about avoiding critical short-term rental tax audit triggers and understanding what is and is not deductible when you have a short-term rental. Many people make big mistakes here, and it can cost you dearly. So please listen to our dialogue as the presenters go through some 3 critical issues that you may want to consider carefully before you take any steps to make deductions or even consider the use of your property.
Imagine you buy a $500,000 beach house, right?
Sounds pretty nice.
Yeah, right? You rent it out on the open market all year, totally legitimate.
Mm-hmm.
But then you get hit with a $20,000 IRS penalty.
Ouch.
And the kicker is it's all because you let your sister stay there for 1 week. Even though, and this is the crazy part, she actually paid you the full fair market nightly rate.
Yeah, that is a brutal trap. It really is.
So welcome to our deep dive today. We are getting into the invisible and honestly incredibly high-stakes world of short-term rental tax law. Because, you know, when we usually talk about real estate, the conversation is all about tangible stuff.
Right, the things you can see.
Exactly. You check out the ocean view, you inspect the foundation.
You argue over whether the granite countertops are updated.
Right. You assume what you see is what you get. But when you step into the short-term rental market, that physical assessment is, it's not even half the story.
No, not at all.
The most valuable thing about that coastal property you just bought might not be the view. It's actually this completely invisible, incredibly powerful tax shield.
Yeah, that invisible shield is exactly what we're looking at today.
Right. We're talking about accelerated depreciation, deducting travel, and, leveraging operational losses to basically wipe out a massive tax bill.
But there's a massive catch.
Oh, there is always a catch with the IRS.
Right. The problem with an invisible shield is that you can't easily see when it has a crack in it until, an auditor is literally pointing it out to you.
Oh, which is the last thing anyone wants.
Exactly. Financial mechanisms that offer this level of immense advantage, they just never exist in a vacuum. The benefits are super lucrative, but they come with severe oversight.
So if they're watching closely.
Oh, the IRS watches short-term rental owners with intense scrutiny. Precisely because the tax code allows for such aggressive wealth preservation here. These properties are prime targets for audits.
Yeah, and a single misunderstood rule can just completely unravel years of strategic planning. Which brings us to the actual mission of our deep dive today.
Let's get into it.
We are pulling from this really insightful article by Bill Anderson over at Retire Coast. And we're unpacking the 3 critical wealth-destroying tax mistakes that trigger these IRS audits.
These are the big ones.
Yeah. We're exploring how an investor's instinct to, just maximize returns right now can actually force the sudden reclassification of a property.
Which ends up costing thousands in back taxes.
And accrued interest. So we're stripping away the myths and looking at the cold, hard mechanics of how the IRS actually views your investment.
And I think it's important to state up front, these aren't just minor clerical errors we're talking about today.
Right. It's not like you lost a receipt from Home Depot.
Exactly. We aren't discussing losing a hardware store receipt. We are analyzing fundamental misunderstandings of tax philosophy.
That's a good way to put it.
Because what this really boils down to is the core philosophy of investing. Real wealth is built through strategy, not shortcuts.
No shortcuts.
Right. The IRS provides a really highly specific map for these deductions, but they absolutely do not reward guessing.
So let's jump into the first trap. Because before you can even think about welcoming your first guests or chasing superhost status, you have to actually value the asset you just purchased.
Right, day one stuff.
Which leads directly into trap number 1, the depreciation blunder, or what the article calls the land illusion.
This one catches so many people.
I bet. Because depreciation is arguably the ultimate tax shield for real estate investors, right? The IRS basically allows you to deduct the natural wear and tear of your rental property from your taxable income over a period of 27.5 years.
Yeah, it's what accountants love to call a phantom expense.
A phantom expense, meaning you get to claim this massive tax deduction, which lowers your overall tax liability without actually spending any cash out of your pocket during that specific tax year.
It literally feels like magic on paper.
Right. But there's a catch to that phantom expense.
A big one. The IRS only applies it to things that actually physically degrade over time. So the unbreakable rule of real estate taxation is that you absolutely cannot depreciate dirt.
You can't depreciate dirt because land doesn't wear out.
Exactly. I mean, a hurricane might come through and completely wipe the structure off the map, right?
Yeah.
But the physical coordinates on the earth, they remain intact. You can only depreciate the physical building sitting on top of the land.
It's like buying a framed masterpiece at an auction, right?
Yeah.
And then trying to write off the value of the blank wall it happens to be hanging on.
Oh, that's a perfect analogy. Yes.
The wall isn't degrading, it's just the location. The art, or in this case the house, is the actual asset that requires preservation and maintenance.
That is exactly the mechanical way you need to view it. But the single most common, really catastrophic mistake new short-term rental owners make is looking at their closing documents.
Right, the final paperwork.
Yeah, seeing a purchase price and just using that total top-line number as their depreciable basis on their tax returns.
Just plugging in the whole amount. Let's actually run the numbers on how quickly this triggers an audit, because the Retire Coast piece has a great specific example.
Let's hear it.
So we have Sally and Bob. They purchase a beautiful $500,000 property on the Gulf Coast.
Nice.
Yeah. They plan to use it as a hybrid vacation home and a short-term rental. Tax season rolls around, they file their Schedule E, and they input that full $500,000 purchase price as their starting depreciable basis.
Oof.
Yeah, they basically tell the government the entire $500,000 is slowly degrading.
And then, usually about 3 years later, the audit notice arrives.
Just like clockwork.
Yep. The auditor pulls their file and immediately spots the structural flaw. They are depreciating dirt.
Because they never officially separated the land value from the building value, right?
Exactly. In their initial calculations, they skipped that step. So their entire depreciation schedule is just disqualified from day one.
Wow. So thousands of dollars in back taxes plus compounding interest instantly become due.
All because they overstated their deductible expenses.
Mm-hmm.
It is an entirely unforced error.
That's terrifying. I mean, if you're listening to this right now and you're mentally reviewing your own Schedule E,
Probably sweating a little bit.
yeah, try to remember if you used your closing price or if you backed out the land value. How do you actually legally separate the wall from the masterpiece without just taking a wild guess?
Well, you certainly can't guess.
Right, because obviously a half acre of beachfront property in Florida is worth way more than a half acre in Ohio. There's no universal flat rate for dirt.
No, there isn't.
Yeah.
So you have to leverage government records against the government tax collectors. You basically use their own logic.
How so?
Look at the positive example outlined in the source. Let's talk about Marcus.
Okay, Marcus.
Marcus buys a very similar $500,000 coastal property. But before he claims a single penny of depreciation, he goes online and pulls the official county tax assessor's card for his new parcel.
Right. And I know exactly what he finds there because it is usually a source of immense confusion for new buyers.
Oh, absolutely.
The county tax assessor almost always has the total property valued significantly lower than what you actually just paid for it on the open market.
Almost always, yeah.
So the county might assess the entire property at, say, $300,000, claiming the land is worth $60,000 and the building is worth $240,000.
Right.
And the instinct for an investor here is to panic, thinking they massively overpaid, or to just ignore the county's lowball number because it doesn't reflect the $500,000 reality of their bank loan.
But the raw numbers on the assessor's card are actually irrelevant to Marcus.
Oh, really?
Yeah. What matters is the mathematical relationship between those numbers.
Right.
The county has officially declared that the building which they valued at $240,000 represents exactly 80% of the property's total $300,000 assessed value.
Ah, okay.
So Marcus isolates that 80%. That's his building ratio.
He finds the government-approved percentage.
Exactly. He then takes that 80% ratio and applies it to his actual real-world purchase price.
So 80% of his $500,000 purchase price.
Which is $400,000.
Okay.
That $400,000 figure becomes his legal, mathematically sound, IRS defensible depreciable basis.
That makes total sense.
Yeah, so when his tax return is inevitably reviewed, the auditor sees a defensible calculation based on public data. and the file just sails through without a single red flag.
Okay, so you've established your baseline tax shield by properly isolating the building's value using the government's own ratio.
Step 1 complete.
But, and this is a big but, that baseline is incredibly slow. I mean, realizing a tax shield over 27.5 years requires immense patience.
Which most investors don't have.
Right. The natural instinct for any ambitious investor is to ask, how can I speed this up? And that intense desire for acceleration is exactly what leads investors to abuse the renovation rules. Which brings us to trap number 2, the renovation write-off trap.
Yeah, this is where people try to get too clever. The tax code does acknowledge that not everything inside a house lasts for 3 decades.
Right, like a fridge won't last 27 years.
Exactly. So through mechanisms like bonus depreciation, Section 179 expensing, or the $2,500 de minimis safe harbor, the IRS allows owners to completely bypass that 27.5-year wait for specific items.
Okay.
You can immediately write off the entire cost of appliances, furniture, and certain business expenses in the exact same year you purchased them.
Okay, let me play devil's advocate here for a second.
Go for it.
If the IRS legally allows me to utilize a safe harbor rule to take a massive upfront deduction, why wouldn't I take every single penny right now?
It's tempting.
I mean, $1 today is fundamentally worth more than $1 tomorrow, right? Because of inflation and the time value of money. The ultimate goal of real estate investing is cash flow. So why wouldn't I want to aggressively zero out my taxes this year to keep more cash in my pocket today?
See, that intuition makes perfect sense if you're just looking at a spreadsheet for this year. But it is strategically flawed when you apply it to a lifelong tax strategy.
How so?
Well, first, the IRS operates on the concept of useful life. A television becomes technologically obsolete in 5 years, right? Mm-hmm. But a roof can protect a house for 30 years.
Right.
You cannot force a long-term asset into a short-term tax bucket just because you want the cash today. And furthermore, taking the deduction today isn't always the most profitable move anyway.
Wait, really?
Really? This is where the wait and save strategy comes into play.
Okay, explain that. How could delaying a tax break possibly result in saving more money? If inflation is eating away at my dollars every year, pushing a deduction into the future seems like I'm willingly taking a discount on my tax shield.
You have to look at the trajectory of your tax brackets. If you are just starting your career or maybe just launching your short-term rental business, you might be in a relatively low tax bracket today, say 22%.
Makes sense.
So taking a $10,000 deduction today saves you $2,200.
Right.
But if you expect your W-2 income to grow significantly over the next few years, pushing that depreciation into future years, when you might be sitting in a 35% tax bracket, means that exact same $10,000 deduction is now saving you $3,500.
Oh, wow.
Yeah. The jump in your tax bracket dramatically outpaces standard inflation. By spreading the deductions out, you actually retain significantly more total cash over the life of the investment.
That completely flips the conventional wisdom of deduct everything immediately on its head.
Totally.
But of course, people still try to rush it. They aggressively try to force massive structural renovations into immediate upfront deductions, which just leads to terrible, illegal mistakes.
Yes, it does.
The Retire Coast piece details an investor named David who falls right into this trap.
Poor David.
Yeah. So David buys a dated condo and spends $40,000 completely gutting it.
A full rehab.
A full rehab. And he is absolutely desperate to wipe out his tax liability for the current year. So he decides to abuse that de minimis safe harbor rule you mentioned, the one that allows you to write off routine items under $2,500.
Oh, no. I know where this is going.
Yeah. David instructs his contractor to take the $40,000 gut rehab bill and literally break it into 16 separate invoices of $2,500 each.
That is so blatant.
And he labels them with vague terms like drywall repair or plumbing fix.
I mean, it's the equivalent of buying a brand new luxury vehicle, but asking the dealership to ring up the steering wheel, the engine block, and the tires on separate receipts.
Right.
Just so you can claim you merely bought a series of disconnected car parts for the office.
Yay.
The IRS does not care about the creative fiction of your paper trail.
They look at the actual reality.
They look at the finished physical product. And an auditor caught David's invoice splitting immediately.
I'm not surprised.
The de minimis safe harbor is designed for routine maintenance. Buying a laptop, replacing a broken window. It is not for disguising a capitalized structural improvement.
So what happened to David?
The IRS disallowed all those fragmented expenses, ruled the project a structural overhaul and forced him to depreciate the entire $40,000 over 27.5 years anyway. Plus penalties, I'm sure.
And I am looking at the mechanics of David's situation in the source material, and there is actually a massive secondary failure here, too.
The passive loss limitation.
Exactly. Even if David's shady invoice splitting had somehow miraculously slipped past the auditor, it wouldn't have actually helped him. The source points out that David had a very high W-2 income from his corporate day job.
Right.
So how does a software sales salary or a medical degree interact with a beach house renovation in the eyes of the IRS?
Well, it introduces a massive firewall. The IRS essentially builds a wall between the money you make actively, like your W-2 salary, and the money you lose passively.
And real estate is passive.
Right. Paper losses generated by real estate depreciation are passive. Unless you or your spouse qualify for real estate professional status, which is a highly scrutinized designation requiring hundreds of hours of documented active management.
Which David definitely wasn't doing while working a corporate job.
Exactly. So without that status, your passive rental losses generally cannot be used to offset your active W-2 income.
Wow. So David risked a brutal audit, committed blatant tax fraud by instructing a contractor to doctor invoices, and incurred thousands in penalties all to manufacture a massive year-one paper loss that his high W-2 income prevented him from even utilizing.
It is a spectacular failure of strategy on every conceivable level.
That is just tragic. So let's compare that disaster to Elena.
Elena did it right.
She really did. Elena also spends $40,000 renovating her short-term rental, but instead of playing games with invoices, she uses the tax code exactly as it was engineered.
She strategized.
Right. She spends $15,000 on new appliances, a living room furniture set, and smart TVs.
Because Elena recognized that the IRS classifies those specific items as having a 5-year useful life.
Okay.
And because of that specific classification, she was legally permitted to utilize bonus depreciation to write off that entire $15,000 in year one.
Which is completely above board. And the remaining $25,000 went entirely to a new roof and an upgraded HVAC system.
Structural.
Exactly. She recognized those as structural components, so she capitalized them over 27.5 years. She maintained pristine bank statements, secured a massive, entirely legal upfront deduction for the furniture, and established a steady, multi-decade stream of tax savings for the roof.
She completely avoided IRS scrutiny because she let the mechanics of the tax code work for her rather than trying to outsmart the system.
Textbook compliance. Okay, so the structural foundation is set. The property is properly valued. The land ratio is applied. The renovations are legally categorized. And the new smart TVs are mounted on the wall.
Ready for business.
The doors are finally open, and the first guests arrive. But this is where the emotional reality of owning a vacation home collides violently with the rigid logic of the IRS.
Yeah, this is the tough one.
What happens when your very first guests are your own family members? This triggers trap number 3, the family discount trap, which is governed by IRS Section 280A.
And this specific trap is often the most heartbreaking for investors.
Why is that?
Because it catches people who are simply trying to be generous to their loved ones. The IRS heavily scrutinizes how much an owner actually uses their own vacation property for personal purposes under Section 280A.
Right.
If you miscalculate this, you don't just face a minor penalty. You lose your rental business status entirely.
The whole thing.
The whole thing. The property is forcefully reclassified as a personal residence. All of those beautiful depreciation schedules, the bonus depreciation on the TVs, the careful tracking of the roof, they're severely restricted. You can no longer claim a business loss to offset your other income.
The formula seems straightforward at first glance, though. To maintain your lucrative business tax status, your personal use of the property during the tax year cannot exceed the greater of two numbers: 14 days, or 10% of the total days the property was rented to strangers at a fair market price.
Right, simple math.
So if you rent it out for 100 days, 10% is 10 days. Because 14 is greater than 10, your absolute ceiling for personal use is 14 days.
The math is simple, yes, but the definition of personal use is where the trap snaps shut.
Okay.
There is this massive, pervasive myth in the short-term rental community that if your family member lives in a different household, files their own taxes, maybe even lives in a different state, they're legally just a regular guest.
I mean, that sounds logical.
It does, but the IRS does not care about separate addresses. They care about bloodlines.
That is wild. I'm looking at Section 280A here, and this family discount rule seems completely paradoxical. Well, if my sister wants to rent my beach house for a week, and I tell her, look, I have to run it like a business, so I charge her the exact same $300 nightly rate that a stranger on Airbnb would pay, my bank account looks identical.
Yep.
The economic reality of the transaction is identical. So why on earth does the IRS care about our shared DNA if the financial transaction is fully market rate?
It comes down to the legal concept of an arm's length transaction.
Okay.
The IRS views family fundamentally differently than the open market because familial relationships inherently carry the potential for hidden wealth transfers, kickbacks, or, non-monetary exchanges of value that the government just cannot easily track.
Like an under-the-table deal.
Exactly. Even if she pays you $300 a night on paper, the IRS assumes that because she is your sister, the transaction is compromised. Therefore, every single day she stays there counts against your 14-day personal use limit.
Even if she pays a premium, the money changing hands does not sever the bloodline in the eyes of the tax code.
It absolutely does not.
So, who exactly is on this banned bloodline list?
The IRS draws a very strict, specific boundary here. Family is defined as ancestors, meaning your parents and grandparents.
Oh, okay.
Descendants, your children and grandchildren. Siblings, your brothers, sisters, half-brothers, and half-sisters, and of course, your spouse.
It's like a bouncer at a club checking DNA instead of IDs.
Yeah.
But interestingly, the source notes the bouncer doesn't care about your cousin.
That's right.
Extended relatives like cousins, nieces, and nephews do not trigger the bloodline rule, provided they actually pay the full fair market rent.
Right. The restriction is strictly vertical ancestors and descendants, plus your immediate horizontal siblings.
Got it.
Let's examine how this destroys an otherwise sound strategy by looking at Jim and Karen from the article.
Oh, this one hurts to read.
It really does. So they successfully rented their beach house to strangers for exactly 100 days. As we established earlier, that means their personal use limit is capped at 14 days. Jim and Karen take a vacation there themselves for 10 days, leaving them with 4 permissible days for the rest of the year.
Okay, they're cutting it close.
Later that summer, they allow their adult daughter to stay for a 7-day trip. They charge her full market price to ensure they are, quote, keeping things strictly business.
And the audit notice arrives.
Yep.
The auditor pulls the booking log and cross-references the names. Jim and Karen's 10 days plus their daughter's 7 days equals 17 total personal days.
They've breached the 14-day ceiling.
So the property is immediately reclassified as a personal residence, and their ability to claim a loss on their Schedule E is completely wiped out.
The financial devastation of that simple 7-day trip is staggering. And it's just because they fundamentally misunderstood the IRS definition of personal use.
But the tax code is nuanced, right? There is a specific mechanism to spend time at your property without it triggering that personal use tally.
Yes, there is an exception.
Which brings us to John and Linda. Let's look at their situation. They rented their property to strangers for 150 days.
Okay, so 10% of 150 is 15. So their personal use limit is 15 days.
Right. They vacation at the property for 12 days, leaving them with exactly 3 days of buffer.
Pretty tight.
Very. Then in November, a storm hits. John drives down to spend 5 days replacing torn roof shingles and repainting the damaged deck. His total days physically on site for the year is now 17.
So he is over the 15-day limit.
Exactly. Logically, he should be disqualified just like Jim and Karen.
He would be, except John utilized the maintenance exemption.
Aha.
The IRS recognizes that physical assets require physical upkeep. Days spent actively working on, repairing, or maintaining the property do not count as personal use days.
But you have to prove it, right?
Absolutely. John meticulously kept his hardware store receipts, he documented his labor hours, and he logged those 5 days specifically as maintenance days.
He had the receipts.
Literally. Because he had the contemporaneous records to prove he was laboring, not vacationing, his official personal use tally remained safely at 12. He retained his business status, his deductions, and his tax shield.
Which goes to show, surviving an audit doesn't require you to be a constitutional law scholar. It requires you to be a meticulous record keeper.
That is the whole ballgame.
Right. Mixing your personal grocery expenses with your business credit cards. Or dumping your short-term rental income straight into your personal checking account alongside your W-2 salary. I mean, that is essentially sending out an engraved invitation for an IRS examiner to dismantle your life.
Poor record keeping is the ultimate vulnerability. I actually want to share a defining quote from Bill Anderson, the author of our source material, because it perfectly encapsulates this entire discussion.
Please do.
He writes, "There are no such things as tax loopholes. Either an action is in compliance with the law or it is not. Ignorance of the law is no excuse in court."
Wow. That completely reframes how an investor should approach tax strategy.
It really does.
It's not about sneaking through a hidden crack in the wall. It's about walking confidently through the clearly marked doors.
And ensuring you keep the receipt.
Exactly. Keep the receipt.
The IRS provides the exact blueprints for the maze. You just have to follow their directions precisely.
Well said. We just spent a significant amount of time breaking down how incredibly strict the IRS is about bloodlines under Section 280A.
Yeah, the DNA bouncer.
Right. The idea that a sibling paying full market rent still torpedoes your business tax status is a fascinating mechanical quirk of the law. But it leaves me with this lingering question for you to ponder on your own.
What's that?
As the entire real estate market shifts toward anonymous digital booking platforms, and as properties are increasingly owned by complex multi-member LLCs or generational family trusts hiding behind corporate veils, how will the IRS possibly track these familial DNA connections in the future?
That is a very good question.
I mean, when an anonymous digital avatar books a beach house owned by an obscure holding company in Delaware, is the IRS's traditional definition of personal use about to face a massive, unenforceable digital reckoning?
The collision of 20th century tax definitions based on bloodlines and 21st century digital anonymity. It is going to be a highly volatile space for tax law in the coming decade.
It definitely is. So the next time you are evaluating a potential investment property and you find yourself getting caught up in the tangible things, the granite countertops, the pristine ocean view, remember that the most critical wealth-generating asset you are acquiring might just be that invisible tax shield.
And protect it.
Because unlike a broken countertop, you can't easily see when a tax shield is cracked until the auditor arrives to point it out. Keep questioning the financial structures around you, keep pulling the threads on the tax code, and keep learning.